Welcome to Natural Gas World's weekly overview of the news in the global gas industry with me, Joseph Murphy. In the biggest acquisition of the downturn so far, Chevron has agreed to buy Houston-based producer Noble Energy for $5 billion in a bid to build up its US unconventionals position and expand in the East Mediterranean. The all-stock transaction values Noble shares at $10.38 per share, which was around a 7.5% premium to the closing price on July 17th. Through the deal, Chevron will gain new assets in the Denver-Julesburg, Permian, and Eagle Ford basins in the US, and also acquire operations in Colombia, off West Africa, off Israel, and off Cyprus. Chevron will also be taking over Noble's sizable debts, though, meaning that the overall deal is worth $13 billion. But the US major says its financial position is strong enough to make such a purchase. It notably bucked the trend among the majors in the first quarter, posting a $1 billion increase in earnings on upstream divestments, tax items, and foreign currency gains. Among Noble's flagship assets in the East Med are the producing Leviathan and Tamar fields off Israel and the Aphrodite gas discovery off Cyprus. Now, Noble estimated that it had around 990 billion cubic meters in discovered recoverable resources across the East Med at the end of 2018. Its sales in the region, all in Israel, averaged 6.3 million cubic meters per day last year, and production at Leviathan is expected to ramp up to 34 million cubic meters per day by 2023. Now, Chevron believes it can make a $300 million saving in annual costs due to synergies resulting from the Noble takeover. The deal comes over a year after the major failed to buy another Texan producer, Anadarko, after being outbid by Occidental Petroleum. There's a lot of speculation as to whether more large-size M&A activity is on the way. For its part, Chevron has ruled out further acquisitions for the time being, but other big players with relatively strong positions could find opportunities to snap up other struggling independents that have been hit hard by the downturn. Fellow US giant ConocoPhillips has also announced a takeover this week, acquiring the Inga fields in the western Canadian Montney Shell Basin from Kelt Exploration for around $380 million. Again, this is a tie-up to Chevron's existing adjacent operations in the Montney Basin, offering operational synergies. Now, we could see more of this type of transaction going forward, firms taking over assets that complement their existing operations with relatively low risk involved and generating potential unit cost savings. Moving to Russia, Shell has agreed a new 50-50 joint venture to develop 2 oil and gas licenses on the Gaidan Peninsula in the Russian Arctic with Gazprom Neft. Now, these blocks are far removed from any existing oil and gas infrastructure, and this means that any discoveries will therefore have to be very large to justify expanding Russia's pipeline system or developing marine export infrastructure. Gazprom Neft estimates that the 2 blocks could hold around 1 billion barrels of oil equivalent of oil and gas, but commercial potential will only be known after drilling, which is due to start this year. First, Gazprom Neft and Shell will need to close the deal on their partnership, though. Gazprom Neft has tried to get Shell on board at a number of new projects over the years, but has had difficulty closing any deals. Gazprom Neft needs Shell for its expertise and technology because these projects are challenging. But the fact that they are challenging means that many of them are unfeasible at today's low prices. Meanwhile, Gazprom Neft's parent, Gazprom, this week sold its 34.4% stake in Latvia's transmission system operator, Connexus Baltic Grid. Now, Connexus was spun off from Latvia's gas supplier LG in December 2016 under EU unbundling rules, and it has taken until now for Gazprom to divest its stake as required. The Russian firm's exit draws a line under Latvia's gas market unbundling, which has been several years in the making. Estonia and Lithuania completed these reforms years ago, allowing them to diversify their gas imports, boost energy security, and get cheaper gas. This has been Natural Gas World's weekly overview of the news in the global gas industry with me, Joseph Murphy. Thank you, and see you next week.